If you are looking for blue chip companies that are rapidly growing their dividends, have at least 10% upside potential according to analysts, and are leaders in their industries, then you should watch this video. These are 2 out of the 6 companies that I am heavily buying at the moment for my dividend growth portfolio. The first one is Deere and Company. Deere and Co. operates in the industrial sector, specifically producing and selling farm and heavy construction machinery. Its market cap is nearly $110 billion and boasts a dividend yield of 1.5%. Currently, its share price is $390, reflecting a decrease of more than 10% from its all-time high of $437. Over the last 5 years, Deere and Co.'s share price has surged by 140%. I love to see such substantial growth in my investments, especially when it comes from companies that are expanding both in terms of share value and dividends. As a dividend-focused investor, it adds to the appeal. Deere and Co. has consistently increased its dividend for 3 consecutive years, currently paying $5.88 in annual dividends. This translates to a dividend yield of 1.5% and a remarkably low payout ratio of 17%. This low payout ratio indicates the sustainability of the dividend, leaving ample room for potential future increases. Here you can see the recent dividend increases made by the company. In 2021, Deere & Co. raised its dividend twice, in March by 18.4% and in September by 16.67%. In 2023, there was even more impressive performance, with 3 dividend increases. Notably, the last dividend was 8.89% higher than the previous one. The 5-year average dividend growth rate stands at an impressive 12.38%. Personally, I am happy when a company increases its dividend by 6% annually. However, Deere & Co. is surpassing this benchmark by more than 2 times. This is one of the reasons why I love this company. With a 5-year average dividend yield of 1.36%, the current dividend yield of 1.5% suggests that the share price is potentially undervalued. Companies can also reward shareholders through share buybacks, and Deere & Co. is actively engaged in this practice. Since 2010, the number of shares outstanding has significantly decreased from 424 million to the current 294 million shares. This is beneficial for investors as it allows them to own a larger position of the company without having to take any actions. Examining the revenue graph of the company reveals a lack of consistency attributed to the cyclical nature of the company. However, it's noteworthy that with each cycle, the revenue consistently reaches higher levels. Analysts have assigned the company a moderate buy rating with a 12% upside potential, reaching almost $440 a share. A concerning aspect of the company is consistent selling of stocks by insiders. Over the past 12 months, insiders sold $39.64 million worth of shares, with only $250,000 worth of stocks purchased. Insiders currently hold a minimal 0.26% ownership in the company. Given that insiders often possess privileged information, these trends make me concerned. However, institutional investors counterbalance the actions of insiders. Over the last 12 months, institutional investors have sold $12.25 billion worth of stock, while buying $19.06 billion, indicating a consistent growth in their ownership in the company over time. I am bullish about the company, especially appreciating the rapid growth of the dividends. I am actively acquiring shares, particularly targeting a price under $400, aiming to make this position around 4 to 5% of my portfolio. Next on the list is Starbucks. While the company is currently facing challenges, I believe in its long-term recovery and potential to reward us as investors. Starbucks boasts a market cap of $105.4 billion and a dividend yield of 2.45%. However, the share price has experienced an unusual 11.3% decline in the past year, despite being a blue-chip company with a dedicated fan base and prestigious status. The company pays $2.28 annually in dividends, resulting in a dividend yield of 2.46%. This payout has shown consistent growth over the last 13 years. With a current payout ratio of 64%, it leaves room for future dividend increases, although they might not be as substantial as desired. With a 5-year average dividend yield of 1.92%, the current dividend yield is 28% higher, indicating a potential undervaluation of the share price. From 2021 until now, the quarterly dividend was increased from 45 cents to 57 cents per share. Starbucks consistently raises its dividend by a higher single-digit percentage each year, resulting in a 5-year average dividend growth rate of 7.47%. Similar to Deere and Co., Starbucks is actively engaging in share buybacks. Since the end of 2009, the number of shares outstanding has decreased from 1.526 billion to 1.151 billion, underscoring the company's commitment to rewarding shareholders through dividends and share buybacks. Starbucks' revenue has experienced rapid growth. In 2010, it was under $10 billion, and today it has surged to over $35 billion. Analysts currently give the company a hold rating, with a price target of $111.43 per share. Earnings are also projected to increase by 16.2%, rising from $4.07 to $4.73 per share. The concerning aspect here again is the consistent selling of stocks by insiders. In the past year, not a single insider has purchased the stock, while 4 insiders have collectively sold stocks worth $1.27 million. Currently, insiders hold a combined ownership of 1.98%, which given the scale of the company is relatively good. The silver lining emerged from institutional investors. Almost every quarter in the last 3 years, they have consistently bought more shares than they have sold. In the past year alone, they have sold shares worth $7.19 billion, compared to purchasing shares for $23.93 billion. I have confidence that Starbucks' share price will resume its growth, and until then, I am actively acquiring as many shares as possible, particularly while the share price remains under $100 a share. I am optimistic about the company's potential to sustain its impressive dividend growth, contributing to an increase in my dividend income each year. If you are looking to enhance your dividend income, consider adding these 2 blue-chip companies to your portfolio, if you haven't already. This is all for today, but if you are curious why Ferrari stock was up 12% in the last week, you can watch this video. See you soon, bye bye.